Okay, so we are going to start with Chapter 5. Chapter 5 is Accounting for Merchandising and Operations. With this chapter, we are going to start looking at companies selling a product instead of providing a service like we've seen so far in Chapters 1 through 4. So let's think about how we have seen things so far. So in a service organization, we have been selling our time to earn revenue. Some example of those service organizations are going to be accounting firms, law firms. You could have a lawn service, any kind of thing where you're providing a service and you're getting paid for your time. That's going to be a service company. So service companies take revenues minus expenses to get their net income. When we look at reporting income for a merchandiser, this is coming from selling a product to earn revenue. So our product examples could be sporting goods, clothing, auto parts, groceries, whatever products we are buying to resell to our customer. So we're not making them, we are buying a finished product and selling that finished product to our customers. The way that we're going to look at income for that is we're going to have net sales, which we'll get to how we break that down a little bit further, but we're taking our net sales minus cost of goods sold, which is a new expense account that we have, and that's going to give us our gross profit. From there, we're going to subtract out our expenses to get net income. So you can see here that the difference is revenue minus expenses for a service company gives you net income. We're adding in a subtraction here of our cost of goods sold to give us our breakout line of gross profit. All right, so before we can sell any items to our customers, we have to buy them, right? And to buy them, we have to have cash. So our cycle for our operating cycle for a merchandiser is going to start with cash. We're going to use that to purchase inventory, which is a new account we're going to be having. Merchandise inventory is an asset. And then we're typically going to sell to our customers on credit sales, which means we're creating an accounts receivable. And then after the terms that we've set up for them, we're going to collect that cash. Once that cash is collected, we're going to start that cycle over again, and we're going to buy more inventory to sell, and the cycle continues. All right, so this is one of the graphics that is very important to make sure you have. You're going to see this information throughout the chapter, and you will probably even see it in Chapter 6. So this is one where we're looking at the beginning inventory plus purchases, so plus our net purchases, gives us the total merchandise we have available to sell. From that, once we know that, if we have ending inventory, we can figure out what the cost of goods sold is, or if we know cost of goods sold, we can figure out ending inventory. So we can solve for the missing variable as long as we know one piece of that information. So again, this slide is one that's going to be helpful going forward too. All right, so when we look at the different inventory systems, we have something called a perpetual inventory system, which is what we're going to use, or a periodic system. Perpetual inventory systems are where we are updating the records every time we make a purchase and every time we sell a product. Where periodic, they're updating it periodically. So typically at the end of the month or the end of the accounting period, they're going to update their inventory. That's not realistic because we know that in retail stores, if you're not updating your inventory frequently, you don't know what you have and what you don't. So you could be midway through the month and be out of a product that's not sitting on your shelf anymore that's still in demand. But because you don't know that in your inventory system, you don't know that you needed to reorder it. So perpetual inventory systems are going to keep us up to date as we do things. So that's what we're going to be using. All right, so let's look at how we're going to be analyzing and recording transactions for purchases using the perpetual inventory system. All right, so purchases, again, we're just buying an asset. The asset is inventory. Here we're going to see it called merchandise inventory. Whether you see it called merchandise inventory or just inventory, they're both the same asset. It's the inventory you're buying to sell to someone else. So on November 2nd, Z-Mart purchased $500 of merchandise inventory for cash. You'll notice that it says without discounts here, and you'll see why in the next slide what we're talking about when we say discounts. But for now, we're just purchasing inventory that we paid $500 for. So we're going to debit merchandise inventory, the asset that we're buying, that we're going to own, and we're crediting cash because we paid cash for it. So cash is decreasing. Now the next part talks about cash discounts. And what that is based off of is credit terms that are set. And if you pay before the last final credit terms, then you are offered a discount. So when you are a merchandiser, the faster you get your cash, the better off you are to be able to buy more inventory. So you try to encourage your customers to pay you sooner so that you can get that inventory faster and be able to sell it to your customer again the next. So this one, it shows Z-Mart purchased $500 of merchandise inventory on account, and it says credit terms are $210 net $30. So $210 net $30 means that we get a 2% discount if we pay within 10 days. If not, that's okay. The terms are set for a total of net 30 days, which means you have 30 days to pay it. But if you pay it within 10 days, then you get a 2% discount. So when we purchase it, that part doesn't matter. It's when we pay it that we would get that discount because it's based on when we pay it. So when we're purchasing it, when we're offered a discount, the purchase looks the same. We're still going to be debiting merchandise inventory, and we're going to be crediting accounts payable because this time it's on credit. We didn't pay cash, we're setting it up on credit. So we're debiting merchandise inventory and we're creating a liability that we're going to pay in the future. So we're crediting accounts payable. All right, so let's talk about those purchase discounts and how those credit terms are laid out. So again, I said that if it said 210 net 30 or 2/10 N 30, that means you get a 2% discount if you pay within 10 days. 10 days is how long the discount is available. If not, the balance, the total, is due within 30 days. 30 days is the credit period. All right, so if you pay early, you're guaranteed that discount. So it is reducing the cost of what you're paying for that inventory. So if we pay within that 10 days in that discount period, we're going to get a 2% discount, which reduces the cost of our inventory. Remember, this is an asset, so we put it on the books for what we actually pay for it. All right, so here's just an example of what an invoice is going to look like. So when we buy inventory, they're going to send us an invoice telling us when we have to pay it. It's going to tell us who it was sold to, the address. It's going to give the invoice date and number. It gives a purchase order date. That's the date that you got authorization to purchase this inventory. It tells you what salesperson took your order, what the terms are. Again, we see 210 net 30. It also talks about freight. This says FOB destination, which we'll get into shortly. And then it's telling you how they're shipping it. It tells you the items you ordered, the total amount, and how much you would pay if it was net of the discount. And that's what that $4.90 is. So we would get 2%, which would be $10. So we would actually pay $4.90 if we paid it within the discount period. All right, and that's what this entry is going to look like. So remember, purchases, we're purchasing an asset. We want the asset to reflect on our books what we actually paid for it. So when it's time to pay for that purchase that we made, we are debiting accounts payable for that full $500 to clear out the debt that we created because we're paying that full debt. We are applying that 2% as a credit to merchandise inventory because, again, that 2% is reducing the cost that we are paying for the inventory. So we are going to credit merchandise inventory so that merchandise inventory account reflects the amount we actually paid for it. And then we're going to be crediting cash for $4.90, the difference between what we owed minus the discount. So 500 minus 10 is $4.90 that we actually owe them. This is what we're going to see it look like in the T account. So we can see that our accounts payable ends up being 0 after we make the payment. Merchandise inventory reflects that we actually paid $4.90 for this inventory, and our cash shows that we actually paid out $4.90 for that transaction also. All right, if we don't pay it by the discount period, so if we didn't pay it within that 10 days and we wanted to pay it within 30 days, that's okay. We just don't get that 2% discount. So in that case, we will be debiting accounts payable and we will be crediting cash for the full amount, that full $500. All right, what happens when we make a purchase and there's a problem with the inventory we bought? Well, there's a couple of different ways it can be handled. First, we can return it, which would take it out of our inventory and send it back to who we purchased it from, to the supplier. Or sometimes we might call that supplier and say, hey, we received a refrigerator in our shipment and there's a dent in it. So they're going to offer us what they call a purchase allowance, which reduces the price of it to us for a defective or an issue with our merchandise. We keep it, and then therefore we can sell it to our customer for a lower price. So we've all seen those scratch and dent things for appliances. That's a good example of this, where we could say, okay, you can give us an allowance which will reduce our cost, and then in turn we're going to turn around and we're going to reduce our cost to our customer, and there might be someone still willing to buy it even though it has a small dent. Maybe that's going to go against the wall and no one would ever see it. So they're willing to take that price reduction just like we are. So instead of returning it, we're going to keep it and we're going to reduce that cost using what's called a purchase allowance. It still reduces the cost of our inventory, and we have to report it as such. So we got a purchase allowance. This one says Z-Mart issues a $30 debit memorandum for an allowance from Trex for defective merchandise. So we bought merchandise from Trex. It was defective. We called them and they said, okay, we'll give you a $30 allowance. So to apply that on our books, we're going to debit accounts payable to reduce how much we owe them by that $30. And it also reduces the cost of our inventory. So we're going to credit merchandise inventory. However, if we returned it, that's a different story. We're going to take it out of our inventory. So this transaction here shows that we purchased $250 of merchandise on June 1st with terms of $210 net $60. So that's the June 1st entry. We debited merchandise inventory, we credited accounts payable, both for $250. Then on June 3rd, Z-Mart returns $50 of goods before paying the invoice. So if we're returning it, we are sending it back to the supplier, which means we don't owe them that money. So we're going to debit accounts payable to reduce what we owe them. We're also going to credit merchandise inventory because we're taking that out of our inventory. So we're reducing the inventory on hand by $50 because we're returning inventory to them. Then when they pay on June 11th, we're taking a 2% discount. Remember though, we can only take the discount on what we actually owe them. If we started with $250 and we returned $50, then we actually only owe them $200. So that's what we're going to return. That's what we're going to pay for. So we're going to debit accounts payable for the full $200. We're going to credit merchandise inventory for the amount of the discount. Discount comes from 200 times 2%, which is $4. So we're crediting merchandise inventory to reduce the cost of our inventory by the amount of the discount. And then the difference is what we're paying in cash. So our balance that we owe them, $200 minus the discount of $4, and we owe them $196. That's how much cash we're actually going to be paying them. All right, one more thing to look at before we go to our next video. So this is where we're talking about how we're handling transportation cost. So there's two methods. There's FOB shipping point and FOB destination. FOB shipping point means that it is owned by the buyer until it gets to the shipping point. So the ownership transfers at the shipping point. So that means that the buyer owns it while it's in transit. So as soon as it leaves that shipping point, it's the buyer's goods. So that means that it's the buyer's responsibility and it's going to be a cost of our inventory. So we're going to debit merchandise inventory and credit cash if we were the buyer. The other one is FOB destination. Now that ownership transfers once it gets to the destination. So it's owned by the seller while it's in transit. In that case, it's an expense to the seller to deliver it to that buyer. So it will be a delivery expense, which is debited. Expenses are always debited. And we're going to credit cash to pay for that expense. Here's an example. So if we purchase merchandise on terms of FOB shipping point and we had a transportation charge of $75, or if we're the buyer and it's FOB shipping point, that means we pay for the transportation charges. We increase the cost of our inventory for that shipping. So we're going to debit merchandise inventory and we're going to credit cash. This just kind of shows us a summary of the itemized cost. So if we had invoice cost minus any discounts, minus returns and allowances, add in any freight, that's going to give us our net cost of merchandise purchases. All right, that's where we're going to stop for this video, and we'll continue on in sales in the next video.